Hi everybody, my name is Katie Huttenberger and I work as a mortgage loan officer with Homeside Financial here in Ocean City, Maryland. And for those of you who know me, or we've been friends on Facebook for a while, know that I used to put out informational videos, mortgage related of course, to try and help people who were looking to buy a house. And then COVID happened and the market got crazy. We all became incredibly busy, which we're very thankful for. But now that things have kind of leveled off, we all have a little bit more time on our hands. I thought, let's get back into making videos. So I have high aspirations for these videos. I would like to eventually have, better backdrops, have them be edited better. But I was listening to a podcast recently that basically was like, if you want to do something like this, just get started. Action over perfection were the words that they used. So anyway, I thought let's get started. So the first thing that I would like to talk about, first topic I'd like to cover, I want to keep it pretty simple, keep these videos pretty short, is the topic of interest rates. And every time we talk about interest rates, the question comes up, should I pay points? And I think that is relevant now, probably more than it has been in the last couple of years, because rates have been so low and we've gotten so used to that, that the discussion of points never really came up. I would lock people's interest rates, and we didn't even look at charging points because the rates were so low that it definitely wasn't worth it. But now that rates are a little higher, there just aren't rates in the twos anymore. And really, even for a 30-year fixed, rates aren't even in the threes right now. So when we look at rates, the topic when rates are a little bit higher, the topic of should I pay discount points comes into play. And so obviously we all know what an interest rate is. And then some of us have probably heard the term discount points. And so what discount points are extra fees that you could pay to buy yourself a lower than market interest rate. So what we have is we have the interest rates, and then we have pricing to interest rates. And so where the points come into play is in the pricing part of it. You'll have, let's just for a basic example, and I'm just going to use round numbers. They're not true to what rates are today or anything like that. But let's say we have an interest rate for the day of 4%. Just hypothetically speaking, of course, for a 30-year fixed. And let's say that you are talking about buying a $250,000 house, and let's say that you're gonna put 10% down. That's a down payment of $25,000, and then that leaves us with a loan amount of $225,000. So let's say you're talking with your loan officer about locking rates, and let's say that the rates that they have that day, let's say one of them is 4%, and we'll call that the par rate. And what par means is that there's no additional discount points, and then there's also no lender credits associated with that rate. As you go lower in interest rates, there are discount points, and the lower the rate is, the higher the cost to you as the client is to lock at that rate. Then you have your par rate, which costs nothing and credits you nothing. And then you also have rates that are higher than your par rate, and those rates yield what we call lender credits to you as the client. And when I talk about all this stuff, where it all comes into play in terms of points or credits, is pertaining to your closing costs, the amount of money that you're going to have to bring to the settlement table when you go to close on your loan. So with that being said, let's say that the par rate for that day, paying no points and yielding you no lender credit, is 4%. Let's say that we've got a lower rate than that available. Let's call it 3.875. And let's say that there is, I don't know, let's say there's a half a point in discount point cost associated with 3.875. So we all would want to lock at 3.875 as opposed to 4, right? 3.875 is better, our payment's lower, we're just happier moving forward, obviously keeping more money in our pockets. So let's say that 3.875 has a half a point cost, and let's say 4 has no cost at all. If our loan amount is $225, and I'm talking about a half a point cost associated with 3.875, I am talking about a cost to you as the client of $1,125. So now 3.875 doesn't sound as good, right? Because we have to pay a little over $1,100 that we'll never get back necessarily in order to lock at that rate. Now, here's where the point of my video, I want to show you how to make sense of whether or not paying those points is worth it to you financially. And part of it, you probably aren't going to know. We don't all know how long we're going to live in our houses, and that is the biggest piece of it. But to make math sense of everything, if we have 3.875 and we would have to pay $1,125 to lock at that rate, or we have 4 where we have to pay nothing, we're then going to want to look at the difference in monthly payment. And so to give you an example, or to give you a payment, the mortgage payment, principal and interest at 3.875 on a loan amount of $225,000 is roughly $1,058 a month. Now, if we look at 4%, our payment becomes $1,074 a month. So the first thing you're going to want to do when considering whether or not to pay points is look at the cost, which we already did, and then you're going to want to look at the difference in monthly payment. So for this example, the difference in monthly payment is roughly $16 a month, right? So we know that it's a $16 a month savings to pay the additional $1,125 and lock at 3.875, or your payment would be $16 a month higher and you would save that money up front. So to determine if it's worth it to you to pay it, you would want to calculate what we call a break-even point. And the break-even point comes from dividing $16 into $1,125. So 1,125 divided by 16 is 70.3125. That is 70 months. So divide 70 months by 12 months in a year, and it's 5.859 years. So what you have to decide is, do you think you'll keep your house for over 5.5 years? To determine whether or not it's worth it to you to pay points, because only after you've kept your house for 5.5, almost 6 years, will you have recouped that extra $1,125 that you spent to get the lower interest rate, and only after that point will you start to recognize savings. So if I'm buying a house and my plan is to only be in it for a few years and then to move somewhere else or have other plans, then it's not going to be worth it in this scenario for me to pay points for the lower rate. But if I think that I'm going to be in the house for more than 5.5 or 6 years, let's say I'm going to be there for 10 years or 15 years, then in those cases it's worth it to pay the money for the lower interest rate, because although it's going to take you time to recoup the money you spent in terms of savings, in the long run, you'll save more if you plan on being in the house longer than the amount of time that it takes to break even on the money you spent. So I hope this video makes sense. If you have any questions, let me know. I realize that I am talking a lot and I'm talking fast. It's just because I want to get these in the shortest time frame that I possibly can so they're not boring. But anyway, let me know if you have any questions. I hope you enjoyed this video and that you found it helpful. Have a great afternoon.